Good afternoon, everybody. I want to thank the SAA for the opportunity to speak with you today. My name is Steve Weibel with the firm Conway Mackenzie. I am a Senior Managing Director and the Automotive Practice Group lead out of our Detroit office. Today, I'd like to spend a few minutes talking to you about what is happening with the automotive supply base, given that we are now in the fourth quarter and about 10 months into a global pandemic. I will touch on what's happening in the capital markets around automotive and conclude with our view of the longer term outlook in the supplier and OEM community. When talking about automotive, you really can't start a conversation without talking about volumes. And in our world, many of us know there are production volumes and sales volumes. And over time, those should equal each other because obviously OEMs don't build cars to sit on lots or long term. So I just want to spend just a minute on what's happening in the volumes. We're going to end up between 15 and 20% down from a very high peak year of 2019. 2019 was viewed as a very good year globally in automotive. And if you think about the COVID shutdown early on, we were down for about 10 out of 13 weeks in Q2, or about 75%. And 10 out of 52 weeks in a year is about 20%. So being down somewhere between 15 and 20 would suggest that we really are only going to lose the volumes in automotive that were a result of the pandemic and the shutdown that occurred at the OEMs. And then we snap back very quickly, and we're basically back to very close to being near pre-pandemic volumes. And then beyond 2020, you look at 2021, we'll be down 5, 6, 7%. And then 2022 sort of getting back to, on a global and North American/US basis, very close to where we were coming into the pandemic. So in a few short couple of years, it looks like we're sort of back on track, and we'll have about a 10 to 15% average blip for about 24 months. If you think about the automotive industry, and now I'll turn my attention mostly to North America and specifically the US. If you think about the automotive supply base in North America, it's mainly a middle market industry. There are roughly 2,000 suppliers, and of those 2,000 suppliers, about 1,800 are under $1 billion in revenue, which we consider to be middle market. So the average auto supplier probably relies on a working capital line or an asset-based line from a commercial bank. And the banks have been very generous with the auto supply base and frankly, most of their borrowers. The banks went into COVID well capitalized in a very good position vis-a-vis the Great Recession, where, as most of us know, the banking community was in tough shape. So the banks have a lot of capital, and they have the ability to be patient. And most of the commercial lenders that I work with have been very friendly to the automotive supply base, which has allowed the supply base to weather the storm, the 10-week shutdown, and also have the requisite working capital sitting around to relaunch as the industry came back in the third quarter very strong. The Fed has also been generous in that it hasn't caused these banks to classify non-performing assets or troubled debt restructurings as aggressively as before. And typically when a company is in default of some form of financial covenant or has a borrowing-based formula that's not in compliance, banks would be forced to ultimately declare that these loans were in need of special attention. Oftentimes were put into workout and oftentimes classified as something called a TDR. So the Fed has relaxed those standards. That's allowed the banks to look the other way on covenant defaults, oftentimes look the other way on principal payments, and in some cases interest. So that, along with the government stimulus, the PPP, so-called PPP that most of us are very familiar with by now, along with the robust return of the industry demands from the OEMs, has really caused this remarkable recovery. So what is the impact of COVID and ACEs and volumes and trade deals and the election? What does all that ultimately do to the supply base, and what strategies should they be thinking about today? And I think the first thing suppliers should do is celebrate for a few minutes and realize that we didn't end up in a deep recession in automotive and didn't go down to 9 million units like we did during the Great Recession. And the industry didn't lose 30% of the supply base like many so-called experts predicted. We've made it, we've stabilized. We certainly have some uncertainty ahead of us here with COVID, but for the most part, the industry has done remarkably well. But after you celebrate, what are you going to do tomorrow? And I would say that, most larger suppliers need to be thinking about what is happening with technology, what is happening with Wall Street money, these SPACs that are obviously going towards the new tech, the electrification, autonomous vehicles. And certainly, I believe we will see some pretty major consolidations, both on the OEM side, and we've seen the FCA and PSA announcement, and other large tier ones like the Borg-Warner Delphi one that I just mentioned. But I believe we'll continue to see more of those. There just simply isn't enough free cash flow in the automotive industry, especially in the supply base, which has about a 9% historical EBITDA margin, to invest in technology, the billions and billions of dollars that's required to take this industry to, into the next wave of innovation, which will be electric vehicles driving themselves in some form or fashion ultimately. So I think size matters. Again, I referenced earlier that this is really a middle market industry, but size does matter. And I think we're going to see some bigger suppliers get bigger through combinations, through putting their balance sheets together and being able to invest in automotive longer term. That doesn't mean that the smaller suppliers, the under $1 billion ones that I referenced earlier, the 1,800 that aren't going to be needed. They certainly will be. I do believe there will be some consolidation at the lower level as well, some of which will be caused by some of this volatility in the market. I think margins will start to come down a bit as we see inefficiencies due to COVID and labor and material costs and things like that. So we will see some consolidation, we will see some distress, but knock on wood, it doesn't appear that it's going to be anything like many of us predicted a couple of quarters ago. I appreciate everybody listening today. Hopefully I've added some insight as to what's happening in the supply base. And I guess if I were to sum this all up, I would say I believe the auto industry and the supply base in particular are in much better shape than certainly any of us would have predicted when COVID first hit back in the first quarter. We'll see what happens ultimately with the pandemic and a vaccine and consumer sentiment and everything else I've talked about today. But I guess as an optimist, I believe the auto industry is in very good shape, and I look forward to seeing what happens next year. For more information on Conway Mackenzie, please feel free to visit conwaymackenzie.com or reach out to me. My contact information is on the website, our website. I'd be more than happy to talk auto with any of you at any time.